Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we're going to have our EIA show. In the first segment, we're going to look at how some of the different changes or what we should expect on, draws versus builds, what normally happens this time of year, how will that progress? Just because we're going to see, I think, a little bit of lumpiness, especially when you start looking at what has happened on the sweet versus sour, the light versus heavy, because that is where I think a lot of these issues are going to continue to arise. And then in the second segment, we're going to look at, we had our, let's call it the 4th of July lull, and then what really is going to happen as we go through this core summer driving season, and this, as we come into summer where this is normally when we get the most activity. Then we're going to wrap it up with, what is happening with Chinese demand? How are things going to shift when you start looking at OPEC, Chinese demand, what normally happens at this time of year, and what can we expect going forward as we start to get a little bit of a ramp up in activity, especially on the Chinese refining front. So we still don't have some of the charts that you might be used to seeing at this point in time. It's a lot of times it's still vacation, and it'll impact when some of the availability. But this gives you some of that color. So instead of talking about this in the last segment, we'll talk about it here, where global crude oil on the water has come down a bit. You can see that it's just going to kind of waffle back and forth. We're still seeing a lot of crude out there just because there's less going through pipe, just based on what's happening with Russia. So that's just pushing more onto the water. So it's not too much that we're seeing in terms of some of these changes, but it's, again, a good thing to see some of this capacity coming out. And then it's going to be a matter of where is it going? Is it going into land storage? Is it being run directly into the facilities? So that's why we look at crude oil in transit. Crude oil in transit has come down. So typically as it comes down, you should see crude oil in storage, coming back up. But then the pace at which it goes from transit to storage, to offshore storage to land storage is going to, dictate how quickly do we see some of these drawdowns on crude oil on the water. And because of these flows back and forth, that's why we're going to stay at this higher end. What you see here is what we think is going to continue as we go through the year, but really just kind of waffling back and forth. Like right now we're at that low, we'll come back to the highs, and we're going to see some of this maintain these elevated levels. When you look at crude oil and floating storage, it trended higher again. A lot of this is being driven by Asia and West Africa. Asia is going to be, again, that important one to watch, because we've seen some facilities have said that they're not going to take their term contracts term cargoes from Saudi because of the increase in prices. So how much of that is going to come from other areas, especially when you start looking at spreads, and that's something that we're going to talk about in the last segment, when you start looking at some of the spreads, the costs that are coming through, and how is that going to dictate, what's happening with Russia, what's happening with the quote unquote cap, why it really doesn't matter, because people are going to pay above the cap anyway. And we want to look at how is that going to shift. But right now, there's a lot of crude and floating storage. We don't see that moving anytime soon. So when you look at crude stocks, we had a build of 5.94 million. It takes us 6.8 million over the 5-year average, 31.1 million over the year over year. But it's important to look at what normally happens, because typically we normally start getting draws as we start to progress, just because we have refiners that are ramping up. And as they ramp up, you're going to see a lot of this get drawn down, but we want to see how much of that can be married with imports and some of those different shifts. Pad 1 had a small draw of 510,000. Pad 2 had a draw of 2.58 million, with Cushing having a draw of 1.61 million. But remember, if you go back to what we talked about last week, Cushing normally starts to see some of these draws. Pad 2 is going to be impacted based on what's coming from Canada. The spreads have gotten very expensive when you start looking at the spreads coming from the oil sands over and across. Because remember, KXL, or the Keystone XL, was supposed to connect and skip some of this pipe that goes over and across. So again, we're still going to pull it down, but the spreads are getting difficult. So we might see a little bit of a slowdown. We still think it's going to stay above the 5-year average, but it's just going to be a little bit of these adjustments. Pad 3 had a big build of 7.97 million. That takes us 6.3 million over the 5-year, 9 million over the year-over-year. But remember, the Pad 3 is going to be lumpy at this point. What comes down, like where are we in imports? Where are we on exports? And some of that shift is going to continue. And that's where we want to look at, okay, well, what should we expect going forward? Imports are going to remain depressed. Again, it's just going to be a matter of where can we get it from. It's going to continue to be Iraq. It's going to continue to be Nigeria. And then realistically, where are imports? So our imports are starting to come under some pressure. Our exports are starting to come under some pressure. And by some, I just mean that we're still going to be at very high levels. It's just not going to be at these extremes just because of the prevalence of light sweet in the market and some of the shifts from that naphtha into the fuel oil, and how are we going to see some of those interchangeable or exchanges. And that's something that we want to look at when we start talking about petchem versus refining, because that's where what is going to go into some different pieces in general when you start looking at the different streams, whether it's petchem stream or petchem stream. Refining stream or petchem stream. So when we start looking at crude oil inventories, as we've been saying, we think it's going to be fairly sideways. So the comps get a little bit easier as you get through into August. We do think that you're going to see some draws at this point. And it's important to look at, we normally get draws at this point in time. When you look at 17, when you look at 2019, when you look at 2021, we normally start to get some of these drawdowns. And if you look at that 29-year average, even though it's much lower, you can see that, typically this is when you start to draw down into about the first week of September, where you start to balance out and then you start to get some builds. So realistically, it's not crazy to see some draws. There was a little bit of a counter seasonal build, but we want to look at, okay, well, now that we're on the other side of July 4th, we should start to see some of that ramp up in the refining side, getting back to about 95% utilization rates. And that'll help pull down some of this crude, especially because our exports are going to be, our imports will be lackluster. The question will be, and especially when you start looking at where our inventories are, where are our exports? Our exports have really been helping, manage some of these bigger swings, especially when you start looking at where we've been in the past and go back to 2022 at those different levels. And it's going to be important to see, okay, well, if imports are going down, then that's going to leave some of this additional in the system in storage, especially when you start looking at Pad 3. Total commercial, when you look at crude and products, as we were saying, it's just going to be sideways. We don't see too much of a swing up or down. And that's really because we do see some pressure on the gasoline demand side. We do see some pressure on the distillate side. And that's going to keep some of this, a bit fixed. So even if we get some crude draws, we're going to get, obviously, we always get distillate builds this time of year. The question is going to be how quickly are we getting some of those exports into Europe, because they have picked back up. For those that have been watching us, our view or my view is that we were going to see some of these distillate exports come down. But as the east-west east into west ARB or east to west into west to west ARB dropped or closed, well, that kept a lot of that gas oil and a lot of that distillate essentially stuck on the other side of the Suez, which then helps pull from the U.S. So it's going to be really important to see what does that ARB do, because that's going to indicate, okay, well, the ARB is reopened. Therefore, the Middle East, Singapore, or I should say India, is going to send more product into the West Atlantic Basin. And as it closes, then the U.S. will kind of be that swing. So it's going to be an important one to watch. But regardless, for simplicity's sake, we don't see too much of a movement. It'll go up and down. Like, we're not saying it's going to be a straight line or it's going to continue to rise. It's really going to kind of waffle, sideways. When you look at Pad 3, the only time that we were higher, right now we're tied for where we were in 16, 17. The only time we were higher was in 2020. So again, we're butting up against some of these elevated levels that we've seen in the past. When you look at Cushing here, you can see we're starting to get a little bit of that rollover. Rate of change is fairly in line with what we've seen in previous. And that's really going to come down to what are exports doing? What are some of the flows doing coming from oil sands down? So again, this is something that we do see some additional draws coming from the Cushing market. runs, as we were saying, typically because of where July 4th fell, it was at the beginning of the month, so by the time a lot of this is calculated, you're coming towards the end of the month. So we did expect to see a bit of that ramp up. We went from 91.1 to 93.7. Our estimate was about 93%, so it's not too crazy. We should get sometimes we'll get a little bit of a pullback and then a ramp back up. We see this coming into about 95% utilization rate as we go into the end of, let's call it peak season. Maybe we get to 96, maybe somewhere between 95 and 96. But again, this is really kind of where we're going to live. Pad 2 came back 167,000 barrels a day. Pad 3, 349,000 barrels a day. So again, we're starting to see some of that increase in activity, and it's just pulling through some of this additional. When you start looking at production, those production levels are really important when we start looking at some of the different movements, especially when you look at production for distillate versus gasoline, which is going to be important as we go through the remainder of this, active period. Here's that bounce. You can see that the bounce, happened here. We came down a bit more. A lot of that was for some unplanned downtime, some heat-related issues, and then obviously because of the holiday, getting ramped back up. You can see it happened a little bit earlier than it has in the past, but again, just kind of in that comfortable spread. And you could see that why we see, that normal kind of increase as we go through the remainder of this peak period. Imports had a big drop of 1.158 million barrels. That's over 1 million below the 5-year. The big drop came with both Pad 5, which remember is very lumpy, so it's not a crazy sight to see some of that drop, which means that we'll get a little bit of a recovery next week, or I should say this week into next week. And then Pad 3 continues to be on the lower end, 137,000 barrels a day below. And then Pad 2, and again, a lot of that is going to be based on the spreads. A lot of that is going to be based on some of the different pieces that we're seeing, especially when we're looking at Pad 2 activity, what those run rates look like as we go through the remainder of this peak period. When we start looking at some of the different flows, especially as we start looking at Pad 3, here you can see, we were expecting to be a little bit higher. So we should see a bit of a bounce when you look at imports into Pad 3. Again, it's still going to be well below the 5-year average, but we're still a bit lower than we should be at this point in time, which again will pull us a bit higher. Pad 2 is always going to be a bit lumpy. Here you can see it fell below the 5-year average. Net over the last 4 weeks, we're still above. We still believe that you're going to see a bit of a recovery. But again, the spreads are going to be a bit difficult, and that's something that we want to talk about more in segment 3. When we start looking at the physical market and those spreads, which are going to bite a bit harder, especially when we look at WCS and some of the other, some of the heavier crudes coming down. Implied demand had a big correction. Gasoline dropped to 843,000 barrels a day from 9.6 to 8.7, 8.8. Again, as we were saying, we think it's going to settle between that 9.4, 9.5 level. We were saying that we would likely get some big kind of snapback because we've been running a bit higher than we should have, just based on what we've seen, what Gas Buddy has talked about, what Tom has shown. So this is a bit of a true up. So again, we will get a bounce off this low, coming back into, let's call it, from 8.75, likely a bounce to 9.2, and then another bounce to about that 9.4, 9.5, and will likely, stay in that level over the next few weeks. Distillate continues to be a problem. There's some mixed data. We want to look at some of the different pieces. There's been some front end pain on the additionally on the trucking side, but we're getting a little bit of a bounce in terms of some of the cargoes coming in. So that's going to be an interesting one to balance. And again, it'll support us a bit higher And as we've been saying, we expect to be at that 3.5, 3.3, 3.5 million barrel a day. So again, we're on the low end. We'll get that bounce. Jet had that set up, as we were saying, 1.55, 1.65 is kind of the world we're working with right now. So we're at the lower end, which means we'll get that bounce back. Propane, propylene, a drop of 528,000 barrels a day. Again, the pet chem side is a big problem. The margins are tough. And it's going to be the issue of, okay, well, where does LPG go? Are we pricing ourselves into the international markets? Where is the domestic market? And the domestic market is where we see some of those problems. Gasoline demand, you can see that there's always a drop. Like, we always get a drop here. The question is, where does it normally happen and where are we dropping from? So we had a bounce, that's that ahead of July 4th. We had that drop off. You can see that the bounce wasn't as high as previous. The drop was a bit lower. We'll likely get back to that 10-year average, which is that blue line, which sits at about, that 9.1, 9.2 million. So again, it's just, we're going to come back up. It's just, we're not going to get to the same level we've been at in previous years. And it comes down to that pressure on the summer demand side. Just the activity levels just aren't going to be to the same degree that they have been in the past, even when you compare them to 2022 numbers in 2021. So you can see 2021 had that nice little spike. Things are, if you want to call 2021 like that revenge move after some of those lockdowns, like some of that is dissipating as we continue to move forward. Days of supply, again, very stable given where we are versus historics. Gasoline storage, we were saying that it was going to follow 2022. You can see it went a little bit sideways, but we do expect a little bit of that move back up. Based on the data that we're seeing on the demand front, the data that we're seeing on the import numbers, we do expect to see a little bit of those counter-seasonal builds. Distillate had a nice pickup, but when you look at it versus historics, it normally starts to pick up this point in time where you're out of the holiday, you're running refiners a bit harder. That's going to pull some of that additional product into the system. You're going to make more distillate. So when you look at kind of the pivot, right now is where we pivot. Now the question is the rate of change going to stay at this level so that we can close some of this gap as before we get into the shoulder season where things start to ramp back down? Jet, fairly stable. We don't see too much up or down. When we look at the curve, we've moved back into backwardation, which is, again, going to pull some of this product into the market. You can see that we've been at slight contango before. Now we're back into backwardation. So this is going to be something to look in terms of flat pricing versus backwardated pricing, which will keep some of these products moving forward. And then when we look at some of the floating storage in the U.S., we've peaked back up just a touch. And again, it's that back and forth between when is it floating, when does it go from floating storage and get onshored, and those are going to be some of those important pivots, which is why we do see some of that recovery in imports, and then we'll see some of this draw down, and then some of it get replenished based on some of the flows from Iraq and Nigeria over the next few weeks. So that's what we have for you on that kind of holistic view. The next segment, we're going to go deeper into the U.S., some of the different impacts that we're going to continue to see, as we come into that core period now that we're past July 4th holiday.